Hey there, it's Walter here from FX Jake, and I just wanted to talk about this idea of R, which is basically grading your trades based on the amount that was at risk initially, the maximum amount at risk, in other words, the stop loss, and grading your outcome of the trade based on that initial risk. It's an idea that comes from the book called Trade Your Way to Financial Freedom. Trade Your Way to Financial Freedom. That's the name of the book. So if you're interested in, you can get it. That's the name of the book. Now, but the thing right now that's important is just to see why this is such a powerful idea. So I had to find a trade that was a loser, and let me show you an example of why, looking at a trade in terms of R is so much more powerful than just pips or even dollars for that matter. This was a bearish big shadow on the New Zealand Swiss daily chart. This initial stop loss was at 78.08, which you'll notice is just above the high of this candle. The high of this candle was 78.02, so it was 6 pips higher than the high of this candle. The entry price was at 76.50, and you'll notice here that the low of this candle was 76.65, so it was a few pips lower than the low. The first target was 76, which is down here where these candles sort of turned around. The second target was down here at 74.80, and the third target was down here at 72.70. And you can see this trade is now over for me, but it still hasn't come to the stop level, which is right about here at 78.08, which is right there on the chart. You can see it hasn't reached it just yet. So the initial risk is 76.50 to 78.08. So that is 158 pips, isn't it? Sure is. So the initial risk is 158 pips. Now, for me, this trade was closed out at, I think it was 32. So let me just go here to 32, which is right there. So it was a loss of 82 pips. So how do I do this? Well, I say 82 pips divided by 158, because remember, 158 is the entire amount at risk. So I say, I take 82 pips and I divide it by 158, and that gives me my R. Oh, messed that one up. Hold on. Let's go ahead and put it right there. So 82 pips divided by 158, that gives me my R. So if I go 82 divided by 158, that gives me my R. My R is 0.51. That's my R. That's the amount at risk. So I have an R of 0.51. Now, even though I lost 82 pips on this trade, I didn't lose the full amount that I had at risk at the beginning, because the full amount I had at risk, so let's say that I had at risk 1%, then that means that I only lost 0.5%, or actually 0.51% to be precise. Now, it's 0.5% that I lost on my account, but it was 80, what did I say it was? 82 pips? Yeah, 82 pips, I believe it was. So, that's a big deal, right? That's a big deal. 82 pips equals only 0.5%. Now, if I look at a different trade that I took recently, there was one here on the Swiss franc. Let me go back. You know what? Actually, let me go to the live account. Hold on a second. I'll bring up the live chart here. Right here. Okay, so here's the chart. Okay, here we go. So this is the Swiss franc, and you can see there was a sell right here, okay? And the initial risk on this trade The initial sell, the initial risk was from 57 to up here at 86, which is 29 pips. 29 pips at risk. Okay, that's important because I need to use that number 29 pips in calculating my R. So 29 pips at risk, and then guess where it got out at? The trade ended up getting out right here where this blue triangle is, and that was closed at 93.64. So from 57 to 64, that is 7 pips, so 93 pips. So a risk of 29 pips, but an overall gain of 93. So let's do that in here and calculate the R. So the risk of, remember I had 29 pips at risk originally, but, oh no, I gotta do it the other way around. I made 93 pips, and my overall risk was 29 in the beginning. So the R is 3.2. So the overall R on the trade was plus 3.2. Okay? But remember, on that other trade, the other trade over here on the New Zealand Swiss, that was an 82 pip trade loser. An 82 pip trade loser had an R of negative 0.51. And here, a 93 pip winner had a 3.2 R. In other words, for every dollar I risked, I made $3.20 on this trade. And on this trade, which was a losing trade, for every dollar I risked, I lost 51 cents. That is the power of R. If I had looked at these trades in terms of pips, I'd say, well, one pretty much canceled out the other. One trade made 93 pips, and the other trade lost 82 pips. So yeah, I made a few pips in the end, but not much. But this tells me a totally different story with R. R tells me that I initially was looking to risk $1 on this trade, which ended up being a loser, and I lost 51 cents instead. So my R was a lot less than I had initially anticipated risking. And then on the other trade, because I had such a tight stop, a 29 pip stop, just above this high here, and I made 93 pips, I made $3.2 for every dollar risk. So you can see here, based on these two trades, although they seem to be about a wash, actually it was an overall huge winner because my losing trade was only a 51 cent trade, a 51 cent loser instead of the full dollar that I had at risk, and the winner was a 3.2 winner, or for every dollar at risk I made $3.20. So hopefully that helps for you to see sort of the power of using R in your trading calculations. That's really the way to go in terms of looking at trades and following trades and making sure that I'm, in my journal, I know that this trade was not that it was an 82 pip loser, but that it was a negative 0.51 R. And likewise, my other trade, it's not that it was a 93 pip winner, but that it was a 3 plus 3.2 R trade. That tells me the magnitude at which that trade won. So if I risk 1% on the trade, I made 3.2%. On my other trade, I risk 1% and I lost 0.5%. So that basically tells you what's going on with R. I hope that makes sense, and I hope you have a wonderful week full of pips. Talk to you soon. Bye.